All right, guys, headlines are showing a massive 370 billion financing deal with Broadcom, and people are split on this. A lot of skeptics are saying, this is a huge signal that the AI stock sector is in a massive bubble and it's not sustainable. And then other people are saying, well, Broadcom is helping to create access to liquidity, to fund this infrastructure build out, which is needed, right? So in this video, we're going to talk about exactly what this $370 billion deal is. If you've dug into it a little bit, you probably understand, at a high level what it is, but we're going to go a little further as to, how it works and what the risks are for Broadcom and what the benefits are, and whether or not we think, this is actually a huge risk or potentially a bull case for the AI sector to continue to get built out, guys. All right, as always, please like and subscribe. Appreciate you guys following along. Portfolio was up about 0.8% for the week, a little over 1.2 million. Let me know how you guys did in the stock market this week. If you guys want to join the private group, we actually just created a free version, completely free. Click the link, just hit join free. We have a chat. You guys can chat with other investors. I'll chime in there as well, just talking about stocks, what we're investing in. It's a fun community, again, completely free. And if you guys want to actually see what stocks I'm buying and when, as well as the tools I use to analyze stocks, you can join the paid versions as well. But again, you guys can join totally for free. Really quickly, guys, before I jump into that Broadcom deal, a lot of Micron analysts are actually raising their price targets now. And we've seen Micron go up, almost touching that $1,000 per share value again. So, it's kind of funny. Analysts typically, when the stock goes up, then they raise their price target. Then when it goes down, then they lower their price target, right? So they kind of just follow the crowd for the most part, but just wanted to point out there that they are kind of raising their price targets. You guys have probably heard about situational awareness, right? This dude's fund really just blew up over the last few weeks. And I just want to point out, this dude was, putting investors' money on extreme leverage. And it's just like, why, right? Why do that? Like, if you want to trade, I totally get that. Like, if you're a trader watching the channel, I understand. But, really this is about long-term investing, putting positions in place for the long term, 5, 10 plus years. And when you're doing things like putting things on massive leverage, don't be surprised if stuff blows up, right? Because people have been freaking out about Micron and other chip stocks, Broadcom going down over the last few weeks and few months. But if you're not leveraged, you're not necessarily worried about it, right? You're dollar cost averaging, you're building out your positions, and you're getting ready for the stock to skyrocket over the long term. But the stock market for the week was up slightly, about 0.44%. So it did it was a decent week, right? Overall, we had tech stocks kind of mixed. You had NVIDIA up 0.5%. Broadcom took a huge hit, down 8.13%. We're going to talk about why. Really, it's because of that $370 billion financing deal, right? So the market's getting freaked out by that. So we're going to talk about what that was. Micron had a huge week, actually up 10%, AMD up 6.5%, Google down 2.5%, Amazon down 4%. And a lot of this is because of financing, right? Because of, the CapEx build out, the financing, the debt raising. Apple separately was down 2.5%. That's mainly because their products are becoming more expensive, because chips are becoming more expensive. So, Apple's actually got some headwinds coming its way. But let's talk about this Broadcom deal and exactly how it works. And then I'll give you my thoughts as to whether I think this is a bad thing, a good thing, or kind of what the risks are here, everything in between. And I'd be interested to see your thoughts in the comments below. So quickly going to summarize here. So Broadcom launched a $35 billion platform financing vehicle in June, led by Apollo Global Management and Blackstone. So you'll see initially this is a $35 billion deal, but it's estimated to grow to about $370 billion over the next couple of years. So essentially this is an asset-backed structure which funds custom AI chips and infrastructure for labs like Anthropic, while keeping heavy debt off Broadcom's direct balance sheet. And I'm just going to give you a quick, high-level summary of what this is in my own words. So essentially, to build out these data centers, they need financing. They're not going to do it all by cash. And essentially, Broadcom doesn't want to take on the debt itself and put all of that on its balance sheet, right? Because that looks bad. Now, some people say, well, even if you take it off your balance sheet, technically that's a little shady because you're misrepresenting your actual exposure to these debts. But really the way it's working is they're partnering with private capital. So you've heard of private equity, where basically it's like investors putting their money into private companies. The same thing can be done with private debt, right? Private financing. So they're basically investing their money to get a yield on that debt. So, they put the money into the fund. The fund is used to build out the infrastructure. That infrastructure, which are the data centers, are rented out to customers. They're leased out. And then they get that monthly profit from, the lease payments from companies like Anthropic. Now, essentially what Broadcom is doing is they are backstopping. So they're telling these investors, hey, up to a certain extent, to kind of calm your fears about, these customers not paying their leases, we'll backstop a certain percentage of it. Very similar to what NVIDIA is doing, right? This has been going on for a little while now in the AI space. So essentially, they create this vehicle. Think of it as an investor fund, and they lend this money out to build out the data centers, and then they lease out those data centers to customers, and that's how they get their revenue, right? They basically want to yield. So they get these monthly payments from leasing out the data centers. And then Broadcom says, you know what, to make the investors feel more confident about their return, we'll co-sign, almost like co-signing on a loan, right, for a car. And we'll say, hey, up to a certain amount, we will essentially pay you for the data center leases. We will take over those leases. So essentially, if they default, if Anthropic or whoever the customer is defaults, we'll take over the lease and now it's our problem. So we'll either pay it directly or we'll sell it to somebody else, things like that, right? That's in a nutshell how it works. But let's talk about the details and what Broadcom's risk is when it comes to the situation, right? So the headlines are showing 370 billion, but the initial capital is 35 billion, which is structured to fund over 1 gigawatt of compute capacity for Anthropic and other frontier labs. Long-term projections, analysts estimate the vehicle could scale up to 370 billion in senior debt by mid-2029, which is about basically 3 years from now, to meet massive AI data center demand. Now, the structure and backstop. Broadcom provides partial guarantees / backstops on specific tranches. So they're not backstopping the entire thing. Hypothetically, it's going to get to 370 billion over the next few years, which is the estimate, but they're not backstopping the entire thing. They're backstopping certain tranches, which is like certain slices of the pie, right? So they're putting backstops on specific tranches, lowering debt costs to around 5.75% yield for backed portions. So essentially, if Broadcom backs certain tranches or certain slices of the pie, those slices will have a lower yield, meaning they'll charge a better interest rate. And then that makes the financing more possible, right? Because if investors want 10, 15% on their yield, it's going to make it very difficult, right? When debt is expensive, expansion becomes very difficult, right? We saw that a few years ago when interest rates skyrocketed and the stock market collapsed because of this dynamic, right? Because of that expectation. So Broadcom is essentially co-signing to create better interest rates just for certain tranches, and then those riskier uncovered tranches will have higher interest rates, if that makes sense, right? Higher interest rates, higher lease costs for the customers, etc. Now, market impact. It represents the largest private credit transaction on record for a tech infrastructure deal, shifting traditional bank lending boundaries. Now, what is the worst case scenario here? That's what we want to talk about, right? What is the risk for Broadcom? And what is the bull case here? Well, obviously, this is creating liquidity, right? So the bottleneck is infrastructure at the moment, right? So the skepticism is, well, chip stocks are skyrocketing if infrastructure is being built out. Enterprise customers, buying AI services is going up, strongly as well. But the skepticism is that it's not sustainable, right? But at the moment, the bottleneck is the infrastructure. They need more chips, they need more racks, they need more data centers. And, to meet that need, they need financing and they need favorable financing agreements, right? Like we spoke about with the better interest rates. So in the short term, this is bullish because it's creating liquidity. It's creating access to capital. It's creating access to debt right? Which debt, if used properly, is a good thing for the market. It's a good thing for growth. So that's the bull case, right? That is the immediate positive of the situation. Now, the market, showing us that that Broadcom went down 8% this week. The market is pricing in the fact that there are risks. Now, what are the risks? We're going to dive into that here. And what is the absolute downside risk for Broadcom? Now, in an absolute worst case scenario, Broadcom's maximum financial loss is capped at $42 billion in direct credit liabilities, according to a recent BOA stress test. So the headline risk caused a recent, massive drop in the stock over fears that this is an off-balance sheet debt pool that could balloon to $370 billion by 2029. Broadcom itself does not actually owe that full sum, okay? So it looks like the max kind of exposure here is $42 billion. Okay, that's a massive number, right? Now, instead, the real danger stems from the customer defaults from potential customer defaults on highly concentrated hardware leases it backstops. Now, Broadcom provides residual value guarantees and customer lease backstops to satisfy private credit lenders, right? So essentially, they're willing to backstop these lease agreements. Now, in the immediate term, Broadcom holds roughly $29 billion in guarantee exposure on the initial deployment phase. So they're immediately exposed to $29 billion off the bat. Now, that's a big number, right? But we've seen Broadcom, they're printing billions of dollars in profit per quarter. So technically, let's be clear here, this isn't like a bankrupt risk here, right? This isn't like Broadcom is going to go bankrupt because of this deal. But what it could happen in a worst case scenario, if everything went to zero, it would wipe out their profits for multiple quarters, right? And that would tank the stock, quite honestly. Now, how likely is it for all of it to go to zero? Personally, I don't think it's that likely, but in a complete collapse, where, build out hits a complete wall, it's possible we could see, a decent collapse there, right? Now, the scaling peak. If the platform aggressively scales to its maximum planned 20 gigawatt capacity, it's calculated that the absolute economic loss under a complete failure would be about $42 billion, right? So they're initially exposed at $29 billion. Their maximum total exposure in an absolute worst case scenario would be $42 billion, right? And of course, they also have a concentration risk where a handful of customers are the ones really renting out these data centers, customers like Anthropic and OpenAI. Now, Anthropic, I feel relatively comfortable over the next couple of years that they'll meet these lease agreements, just given the fact that they are expected to go public at about $2 trillion. And when you have a company go public at $2 trillion, I mean, even if first of all, they're probably going to raise about $100 billion just off the IPO. That's going to keep them solvent for, maybe a couple of years. Then at a $2 trillion valuation, it's easier to raise debt. They could easily raise another $50 billion off that. It's easier to raise money from printing shares. So at a $2 trillion valuation, even if they only print, let's say 2 or 3% of shares, I think that's tens of billions of dollars, right? So the massive valuation gives them power to raise money through equity funds as well. So really, Anthropic feeling pretty comfortable, at least for the next couple of years. OpenAI, they're not doing as great. We'll see what happens there. But really, there is that concentration risk, right? But in a nutshell, essentially, you have that $29 billion initial risk, right? Again, that's total risk. Even though the headline numbers are $370 billion, really they only have somewhere around $42 billion exposure total. And that's if everything goes bad over the next few years, which of course, everything going bad is unlikely, right? Maybe a 50% loss, is somewhat realistic if things go poorly, but going to zero is highly unlikely because if they take over those leases, they could sell them to somebody else or rent them to somebody else, right? I mean, and again, even in a down market, getting 50 cents on a dollar is probably realistic, right? Just throwing a number out there. So, with Broadcom being down 8% this week, and, to be clear, it is a pretty good size chunk in my portfolio myself. It's disappointing to see, but I do think, the overall $370 billion, number on that deal is a little overblown. Again, $29 billion is the exposure currently, and $42 billion is the expected total exposure over the next few years. But let me know your thoughts in the comments, guys. Do you think this $370 billion deal is a good thing for the AI market? Do you think it's providing, liquidity that is really needed for this generational build out? Or do you think it's a sign that we're, in a bubble situation where companies like Broadcom and Nvidia are essentially, using unorthodox techniques to keep debt off their books, but still co-signing to an extent, which obviously could be a drag on the balance sheet for them if things go sideways over the next couple of years? Let me know your thoughts on that in the comments, guys. Again, let me know how you guys did in the market this week. And if you guys want to join that private group, just created that free tier, completely free. It's on Patreon, which is a very reputable site. Click that link, just hit join free. You could chat, really. The free version just allows you to chat with me, chat with other investors, talk stocks, talk about what we're investing in. And if you guys want to see what stocks I'm buying, when I'm buying, and why I'm buying, you can join these paid tiers as well. So with that said, guys, thank you so much for watching. Hope you're doing well, and I'll see you on the next video.